Good morning and welcome to Moneycontrol. Well, today morning also looks very cheerful for the Lal Street. The market is up, Nifty up about 150 points thereabouts, and the momentum continues very strong. And I have with me a very special guest again to continue our conversation series on how to ride this bull trend. Atul Suri from Marathon Trends. Atul, thank you so much for joining me this morning.
Thanks for having me. Thank you.
So Atul, tell me, every day is an all-time high now, and we are in uncharted territory.
Sure.
Are you excited because you've seen so many highs in your, 30-year career? How exciting is this high? What does it really mean to you?
No, I think it's very, very nice. Of course, every lifetime high is super. The reason lifetime high is special is because theoretically, everything you hold should be in the money. I'm talking at an index level. Stocks are different. So it's always nice to feel profitable, to be and feel like a winner. So lifetime highs are always welcome, and they're special also because, when markets are at lifetime highs, there are no distress selling or there are no resistances per se. That's why we term them as blue sky territories. And very often in these times, as to what we limit or what we think is the upside gets far exceeded. So always lifetime highs are special. Why this one is special for me per se is that I feel that, since ending of 2022, India was actually showing immense quality. In fact, India was one of the few markets that made a lifetime high at the end of 22 when global markets were at 52-week lows. That includes the S&P 500.
Yeah.
Of course, then we had the whole Adani issue that came up in Feb, March, April. And that kind of took the shine away from our markets. But as I like to see this bull market, it's a global repair. You see, 2000 post-COVID, 2021-22 was a very big up move.
Correct.
Then post that 2022 was a year of consolidation.
Right.
In India, it was not so severe, but if you were in the tech-facing world, especially some of the US markets, you'll find that the damage was tremendous.
Yes.
However, after that year of consolidation, 2023, and especially now breaking out to lifetime highs, is a copybook thing. You cannot have the 21-22 kind of 2021 kind of bull market sustaining for long. It needs to consolidate, and which we have done, and that is when the next leg has more legs. So in this whole scenario of global repair, when most markets, whether S&P or the Dow, etc., which are touching 52-week highs, India is the few large markets making lifetime highs.
Sure.
So this clearly shows leadership. Stocks that break out early are very often leaders of a bull market. That's something that I believed in. Similarly, countries or indexes that break out early tend to lead that bull market. So one is obviously a lifetime high, which I told you the importance about. But even in that, if you are the leader, that makes it special. And as far as the Indian context goes, it's not that every time we have seen that. We have always been playing Pied Piper to maybe the US markets or NASDAQ or any such play. But this is one time where we are kind of leading it. So this is really something that, kind of gives me that optimism or the feel-good factor.
Sure. So lots of questions on the Indian market, but before that, let's just touch upon a few macro points.
Sure.
Do you think the worst of the interest rate cycle is now behind us? I mean, globally, has that peaked out?
I think that is probably the most important, asset class or variable you need to look at. How devastating it can be is you have to look at 2022.
Right.
As the Fed started hiking and pretty aggressively, it was kind of a decadal shift, multi-decade shift. You realize that how stocks actually, the whole growth to value kind of churn, it may not show in the index per se because optically it gets offset, but in portfolios it created a lot of damage. In fact, what we term as trend followers, that there was a trend change. The sectors of stocks that led the market earlier during the last 18, 19, 20 actually got churned out. So I personally think that interest rates as they were at, I think the Fed fund rate from almost 50 bips came up to almost 5 or so. I feel that we don't know to the exact decimal, whether there be 1 or 2, but more importantly, the market is going up on the belief that, hey, we are somewhere there. And I don't think that we are going to have inflation that is going to be totally benign, because I don't think commodities are dead and gone. They will keep staying where they are. They will keep moving up and down. I think wage inflation is a bigger issue for the Western economies because they've got a total demographic mismatch. So inflation is not going to be out of the window, but it is a more real world. It is a world you prefer where there is some cost of capital and yet there is growth. Where the cost of capital was almost negligible to almost free, and you had sort of pumped up growth and you had excesses and bubbles happening. I mean, that was not a very sustainable scenario. So I think we'll have to live with this, which I think is the real economics. That hey, wherever there is going to be merit, that's going to do well, and wherever there's no merit is not going to do well. So in a market where it's not that commodities are going to be available free, they are going to have a price to it. It's not that money is going to be available free. In spite of all this, when businesses are able to deliver, I think they will get rewarded. And that is a real sustainable scenario. So I do think that, we are in, I would say, more saner times where both the possibilities are there rather than a one-way street.
Sure. Tell me again, for example, the US economy is now, the interest rates are, whatever they are at a high, the
bond
rate is
just under 3.8 or so, just below 4.
As good as what we were about, 14 years ago. The rates that we are seeing today are really the rates that you saw in 2007, 8 or so, right? So the economy has perhaps not got adjusted to that rate. The markets have reacted, and you've seen that on Silicon Valley, correction in valuations and all of that. But the real economy has not really, perhaps it's just getting adjusted to these rates. Obviously, textbook wise, we all know that higher interest rates are not great for economies. They're not good for businesses, etc. Does that pose any? Do we have to revisit the idea of what kind of returns are sustainable returns in equities globally? And would that also hold good for India?
I also think that interest rates do matter, but they matter at the corporate level where it is such a big part of your cost. There are a lot of companies, businesses, even in the Indian context, where it is not going to be such a very big important cost element. So definitely those companies or businesses are going to reward it. Yes, which are heavy leverage, which have a very high interest burden. So they are definitely going to play it out. But I feel that this is a slow adjusting mechanism. It is, as I said, as quarterly numbers come, people get a deeper understanding. A is going to be differentiated from B. So it is not going to have a market-wide kind of, like how last year, it was across the board and it was so big. Now, that's not going to really happen. Now, what is going to be happening is a little more in the micro sense, and one is going to get a sense company-wise, because every company's leverage is very different, and so accordingly is going to be their interest burden. And that is why these interest rates are going to have an impact on that. I think it's a more slow-moving process, a more grinding process, and rightly so. Money cannot be free. Capital has a cost to it. And those companies which, in spite of that cost of capital, do well, need to be rewarded. And that's the market's job. It will do it. It will do it very well and efficiently.
Sure. And what is your take on the rupee? And I also ask you in the context of the fact that today the differential between US yields and India rates are perhaps again at the lowest ebb compared to the last 10, 15 years. Is that sustainable? And at some point, we might just end up bridging that gap. I mean, if we were to look at a scenario where we are able to, where we want to, that could actually reverse. So, is that a sustainable trend, and what is the implication for the rupee?
See, so sorry. So I feel that the rupee is something that's been managed very well. If you look at the rupee, you compare to most of global currencies that have been moving a lot around, the US dollar also for that point in time. India actually, thanks to all the RBI initiatives, etc., has been in a very good band. And this is definitely very good for domestic business or businesses that are into exports, because there's a certain sense of predictability, the whole thing. But I feel that if I look at the US, the dollar, which is like the mother currency, if you like to see, it is very, very precariously poised. 100 on the DXY is a very, very important support. And it's kind of almost bouncing off that. So if the dollar, sort of gives that level up, I do feel that you can see the strengthening of the Indian rupee. So I think that's a very interesting play that is happening up. And on one side, you've got RBI doing a good job, and second is the weakening USD. So these two factors are going to be the variables that are going to clash at some point in time, and that's where the direction will head.
Sure. And what is your take on the commodity cycle? Where exactly are we? And do you see them go down, or do you see any perceptible change in the next 1 year in the way commodities are moving?
Commodities, we were so used in the last decade to see a one-way secular down move in commodities. It was like with interest rates and commodities, they just were, and inflation was an unknown kind of entity.
Correct.
Post-COVID, due to supply chain issues, etc., you kind of saw this very big surge. And you're seeing post that there is a cool off, especially 2022, you did see a cool off in underlying commodities. However, I don't think commodities are going to go back where they were pre-COVID. I think that the world, whether it was an ESG thing or the alternatives, got to believe that, this is history. We are going to have alternatives for everything. And now the world is realizing that, hey, this whole ESG thing may not be as good as it looks, and alternatives are going to take a lot of time. That runway or that path is going to be long. So I do think that investments are coming back. And it's very important because commodities are not going to be, as I said, where they were. They are going to be range bound, and it is actually a much better and healthier way to be, because, as I said, excesses that happen on one side very often lead to a pullback action. That is why you saw crude at 120, where about a year ago it was, on one particular trade, where it had gone into a negative futures kind of scenario. So when that happens, that also happens. So if you remain in a range, like crude for that matter is very important for India, Brent, I think the 70 to 90 place. At 70, the Saudis come out and do some sort of cartelization and pull it up. But I think at higher levels, pressures do come. Though I think that commodities will be benign, but definitely in a broad range for some time to come.
Sure. And crude itself, I mean, what is your estimation of where we will settle? And is there any, again, a perceptible risk that you see from crude? Because it is stuck at 70 to 80 kind of range, and we are somehow accustomed to this range right now.
I think Brent is headed much lower. I feel that the commodity, the way the stock is behaving, or the way the commodity is behaving, it seems to want to go lower. But as I said, at something around 70, the whole OPEC plus cartel really gets into the act and gets it bumped up. So they are creating an artificial wall, or artificial floor, I may say. At some stage, if the floor breaks, I think that it can hurtle down very fast. So I, for one, think that it's going to give you these, short-term heart attacks kind of things. Like near to 90 could be really a freak-out scenario. 80 is kind of okay. 70 is what we would like it to be. But in this range, at some stage, I think that anything I've seen artificially created or any kind of cartelization doesn't last for long. In the end, the demand, supply, and markets triumph. And I do think that at some stage we are going to see this OPEC plus, I would say, losing this kind of game.
But in the 1 to 3 months, do you see any shock of this?
I think it can head towards 90.
Out.
I think it can head towards 90. 90 is a risk area for it.
Sure. Now coming back to Indian. Okay, one another question on this, whole anti-China sentiment, because we saw that play out for businesses. The China plus one has been a big ongoing theme since 2016 or whatever. And now you're also seeing that play out in the stock markets, because a lot of allocation coming back to India. But then the stock happens every time China is not performing. So the moment China starts to reopen or perform, there is allocation goes back. Is there something different this time?
See, I think that it's going to be gradual. Yes, I know that this whole China plus one and all, it's on and off, what you rightly said. But I think there's more to it than just economics. It's also politics. If you look at the narratives, it's almost the emergence of a new Cold War. The last Cold War ended 30 years ago. That was between the Soviet Union and the West, or US for that matter. We haven't seen a Cold War post that. Now you are really actually seeing that kind of play. Of course, it is not so blatant. It is not happening at a military level, confrontations, etc. But it's happening at the trade. So I think politically also the Western world, and particularly the US, sees merit in moving. So it is more strategic in nature. So I think that suddenly you find this lot of talk of India and the Prime Minister going and getting red carpet welcomes and state dinners and all. I think it's more strategic in nature. It is not because of our doing. Yes, we are doing well, but it is more of their choices, and they really want to project India. That's how I see things politically, and that will show in the markets. It will show why you will see a lot of manufacturing, looking for India as an alternative. And in that sense of the term, yes. And you must remember the size of China is so large that even a few percentage shift to a country like India can make a massive change. So I think it's a work in progress.
Sure. No, fund flow wise, how optimistic are you that this fund flow momentum will continue?
See, the FIIs actually are a function of multiple things. There are alternative markets, there is currency at play. So there are multiple variables, and honestly trying to predict them has been very, very challenging, because you don't know how these macro visible are going to play out, because you'll have to predict multiple variables. But the more important thing, or the thing that has emerged last year, are the domestic flows. Those are tending to be more solid, more reliable. So irrespective of what FIIs do, yes, they will affect the market at an index level, but at a broad market level, the shift that is happening in domestic investor behavior is massive. And this can be very long. Like if you go back to the US between 1980 to 2000, that was that golden phase, for US markets.
Yeah.
The Dow just took off, and it was a secular 20-year bull market, which actually re-rated that country, that market, etc., etc. So maybe we could be in that kind of scenario. And even at that stage, it was the domestic flows, their changes in the 401ks, etc., which we can get into. But I think that was what really created the shift. And probably India could experience not 20 years or whatever, but at the same time, that could be a big shift that's happening.
Sure. So one question based on that, which is India 2023 the same as US in 1982?
I hope so.
In terms of markets?
I hope so. I hope so. I mean, I don't know.
Or has the rally already begun? I mean, are we past the early stage?
I think we are though we don't believe it or don't accept it, but the beauty is that it's almost been 2 years or so where, you've got this very steady secular flows that are happening. So I think it's already on. It's already on.
And in terms of market dynamics, how is India 2023 different from US at 1982? Because, I'm not sure whether markets were front-ending returns, this level of proliferation of investors, information, knowledge, participants, the character of the market.
Right.
The question is, are we front-ending a lot of growth, and a lot of anticipation is already built into stock prices? How much do you worry about that?
Like what my understanding is that the global factors and variables are so much and so many. Initially we could sort of look for companies on 3-5 year basis. We could look for macro trends playing out, but the variables are so much and so many, and they're affecting markets in so way. Whether you've got a war in Europe after how many decades, or you've got a new brewing Cold War that is happening, or a decadal move in bond yields. So what you call is like that decadal moves are happening every year, but they're happening in different pockets, and each one is affecting the market. So I'm getting to believe that it's very difficult to try to predict this 5-10 year kind of scenario. Markets are actually now more like building blocks. We don't know what's going to play out in that sense of the term in the very distant future. So you really have to construct your portfolio by aligning with the trend that there is, because sooner or later, if you keep aligning, you will always be on the ball, and something will really play out, and that is very big. Case in point is defense, right? Defense stocks have been listed for 10 years. They've been dogs. Nobody ever looked at them. Nobody ever made money in them. But you'll realize that in the last 1 year, if you look at defense, it's up more than 100%. If you created a thematic sector index, we have created one. It's up some over 100%. And what has changed? Government has been talking about it, government policy, etc. So you'll find that these today all are in denial and say, oh, defense has moved up. But really, if you look at the runway, the size of opportunity, if these guys can only execute, this can be something massive. So will it be the big trend? Maybe, yes. But at the moment, the trend is definitely up. And it's important for me to keep aligning my portfolio, because in this whole jumble, something is going to really emerge. And the important part is that if you are on the ball, if your eye is on the ball, you will be able to whack it.
Sure. See, Atul, one of the things is also that, a lot of people in the market are inspired by, at least in the last generation, inspired by Buffett's philosophy of buy and hold, buying companies with moat, longevity, etc. Now, this whole idea that, decadal, a decade of returns come in 1 year, or everything's getting front-ended.
Right.
does our overall strategy need to be very different? So like you said, look at defense today, tomorrow it could be another thing. So you need to revisit each one of those themes and play them as they comes. Is that how you look at it?
See, what happens is
or
that
the opportunities to, buy good companies with high free cash flows and hold them for long no longer is a short recipe for...
No, it is a fantastic recipe. It really comes from your expectations as an investor. Very often, like as I was discussing with you that prior to my running my PMS, I managed private money, and today I manage public money. The difference is that private money looks for absolute returns, right? So they have a very different time horizon and expectations. They are ready to wait. It's like what happens in the private equity space. But if you benchmark month on month, which most people have got into the habit of doing, then you'll find that you will always have to be with the eye on the ball. You will always have to align with the trend. Fortunately or unfortunately, that's the way the public listed space and products are structured. That's the way clients are approaching it. That's the way the distributors are approaching it. So what happens is that thing is good to talk about, a 5-year, 10-year kind of things. It makes for very good storytelling. But the fact is that at a client level, people are unable to understand and withstand the drawdowns. Like there is a very big coffee can investing, which has a lot of merit in it. But I said that it's great, you can pick 10 coffee can stocks. But the problem is that nobody gives you a can. That can is something which you don't have to look for. When you look at stock prices 10 times a day, when you look at your portfolio every day, every week, every month, in coffee can investing, then you have to forget for that period of time. That's why the can is not in here, the can is in here.
Right.
It's not, it's that risk-taking capacity, that detachment doesn't come at an intellectual level. It comes from your, your ability, your core. And that is why I feel that privately managed money and publicly managed money have a different approach.
Sure.
In the public space, people may not say it, I'm being very honest about it. But the fact is that everyone is trying to catch the next move.
Sure.
Those are good discussion points and to write about and talk about. But when you go and see the underlying portfolio construct, you look at the portfolio churns, you will find that that is very, very different at times.
Sure. Now, pulling back to the index, first of all, what is your view on Nifty for the rest of the year? How much can we clock?
See, I have been on record on multiple forums talking about an index target of 21,500. And mind you, I was saying this even when the index was at 16, 17,000. So from here, it is about a 12% kind of move. And I think that's a very good move because personally, when I started, I told you about global markets being in a repair. When I kind of project global markets, I sense that there's almost a 10 to 15% move, depending on which country and which index you're looking at. So in this scenario, India also pretty much overlaps. As I said, that this is a global rally.
Right.
But also the fact is that India is at lifetime highs. And when stocks or indexes are at lifetime highs, they very often overshoot.
Correct.
They often attract that kind of play.
Sure.
So 21,500 hopefully is the minimum target, fingers crossed. But I won't be surprised if we outperform because this comes from my core belief that stocks and markets that break out early are the leaders of the bull market.
Sure.
And India is one of them.
Sure. I'll come to that, but before that, what will take the index higher to that level? Because one of the, one of the interesting points in this rally is that the frontline stocks have really not been the ones that have really, busted the charts, so to speak. Whether you look at TCS or any of the index heavyweights, those have not been the leaders of the rally.
Right.
So for the index to be at 21,500, what will be the drivers?
So what happens is that the index is a very interesting animal. Actually, the index is not as passive as it seems. See, a lot of these sectors that post 18, 19, 20, where I said that it was a very narrow market, it was a very quality driven market. So when those stocks move up, their market cap goes up, by virtue of which they all come into the index or their weightages in the indexes go up. But in 2022, as I said, that I thought there's a massive shift in trend. In the Indian markets, I think that the trend has moved away from international facing stocks or global supply stocks, which is your IT and pharma and such all places, to more domestic. So my models or my understanding shows me that we are actually starting or maybe starting a new capex cycle, and there is going to be an industrial revival.
Right.
So what will happen is that this set of stocks were ignored for a decade. So by virtue of being ignored, you will find, like if you see of engineering infra barring L&T, there's nothing.
Yeah. Yeah.
There's nothing of size, right?
Right.
There's nothing of size that is available.
Right.
Everything else is reduced to mid and small caps.
Right.
So when you have a revival happening in this space, you will find that the journey is going to be more of small becoming mid and mid becoming large. And that is why this will take it some time. If this plays out maybe 3 years from now, you will find that the index is more skewed towards this kind of play. So this is the index is the ultimate trend follower. The index is the ultimate, people think the index is passive. It is far from passive. It is a very active trend following, because what does it do? Stocks that go up come into the index, one, and number two is that their weightage goes up because it's market cap driven. So what drove markets for last 3 years are not performing right now because the trend has changed. New stocks have emerged. They are in a different pocket. So that is why optically you will find, hey, you know what, this large cap, these are not doing well. These marquee names of the last, whatever, 5-7 years, but something else is doing well. Till a point and come where these guys actually cool off, weightages come off, and this new space will emerge. So I think that when trends change, you will see this kind of behavior, this kind of mental mismatch that I see playing out.
So therefore, would you say that the drivers of this rally will not be the drivers of the next rally? I mean, if you just look at it 1 year hence, where would you put your money?
Every bull market throws up new leadership. Okay, let me go back to where I began my career. 1990-91, that was a Harshad Mehta bull market. It was led by cement stocks. Remember that whole ACC kind of play?
Correct.
The next bull market was in 2000, which was the IT bull market.
Correct.
Those stocks never did well. And what you had was a new sector or theme, which was IT.
Correct.
The next bull market was 2003 to 2008.
Infra.
It was infra.
Correct.
IT didn't do well.
Correct.
In fact, it underperformed.
Correct.
Then post 2003, 2008, you had a fall, and then I think financials did very well. The whole, private banks and things like that. In that rally, private financials, infra didn't do well.
Correct.
Right?
Correct.
So every bull market throws up new leadership. Every bull market throws up new leadership. So the leaders of the last bull market, where everyone is standing, by virtue of itself being overweight, tends to be a limiting factor. And new sectors or new themes emerge by its very nature, that because they are under-owned. And when performance comes, when earnings come, people don't own them. Case in point is defense, like we were talking about. Like today you have a mutual fund launching a defense fund. I mean, this is like unthinkable. I mean, I could not name more than 5 defense stocks, and you launch a mutual fund. So that really shows how money ultimately gets attracted to where trends are. And that is why trends outperform or do well, especially in...
But Atul, you've been long enough in this industry to, also recognize the fact that some of these thematic funds are just, one way of, capitalizing on the exuberance in a certain pocket, and they might just end up, underperforming in the long run. I mean, that could be one of the trends also.
Most thematic funds have not given much returns. Yeah, very true.
Correct. But sincerely, if we just look at, who could be the next ones to rally, or which pockets will have a higher weightage in the index, let's say 1 to 3 years down the line.
I think it's engineering, infra, construction, electrical equipments. As I said, it's the inward facing. Those stocks that will benefit from an industrial revival, I think will play out. And mind you, as I said, that barring L&T, they're more are in the small and mid cap space. And you've got to go to 2003 to 2008, which is the last time this kind of thing moved. And you will be, people come up and say, oh, they've already run up, they're very expensive, but you'll be surprised how their earnings tend to surprise on the upside. And we are getting into earnings season. So really, I feel that there will be some surprise in those areas. And what looks expensive suddenly looks reasonable.
Sure. And within infrastructure, capital goods, that whole space, is there any pocket that is looking particularly exciting? Because not that market has not recognized the turn in the capex cycle, and a whole bunch of companies, of course, right from the top, Siemens or ABB to, the smaller electrical equipments and lots of, all of them have gone up reasonably. But as you rightly pointed out, if, operating leverage kicks in wherever there is headroom, there is more, and earnings justify, they could just be on a roll for some more time. Any pockets where you see that there is under recognition of this turn in cycle, where the markets are not really recognizing it yet, or in the process of, valuing them?
What I find is that, as I said, that for a decade these companies have not done well in the
Yes.
market, and even the industry itself at ground has been very difficult. So a lot of companies have shut down, unviable projects have shut down, which limits the number of players.
Right.
Right. So for the first few years, these guys are going to really have it good till fresh capacities come up and things, which is again a few years away.
Right.
Because all the surplus capacity is got to be mopped up. You've got to have shortages, and then the capex, and that also takes time.
Correct.
So
Correct.
the few years that these things actually do very well, and that is the work in progress that we are seeing. So as I said, again in cap good space like electrical equipments, like if you see some of these players, they are doing very, very well. Yes, they've run up, yes, they've gone up, but yet there are some companies that are available at very good valuations. And ultimately, if these companies deliver on numbers, suddenly what is expensive becomes cheap
Sure.
or reasonably priced, and this attracts fresh fund money. Like I'll tell you, in the FMCG space, interestingly, we find a lot of opportunities in the food related space. Mostly FMCG is personal products, the soap, shampoo business, but there's also a food business, So you'll find that there are some very interesting plays, because if there is a revival, we hopefully have a good monsoon. And I think a lot of food habits are changing, and that is kind of getting reflected, Indians are moving away from that standard Indian kind of eating habits. They want to explore a little bit more. So I think in the whole FMCG food place, so these are kind of pockets. Defense is something we spoke about. Hotels have done very well. So I
Again,
think
hotels, I mean, is this a trend that will last? Because is this driven a lot by this revenge spending that is happening? Because global travel has perhaps not even, not seen its full, it's not completely come back. So maybe another year or so. How do you see it? Is that an intermediate trend, or is that something that there is a permanent reset?
So the hotel business, like airlines, was very difficult. A lot of hotels were pre-COVID very unviable and it was a very difficult business. I mean, they never really created that excitement, and you can see even something like Indian hotels, which
Asset heavy, low
which is the
ROE.
ultimate brand in the world, etc.
Correct.
There's nothing. But what you're noticing is that ultimately with post-COVID, whatever you call it, revenge travel or whatever, for 1 to 2 years, these guys are doing very well. So they have been able to fill up their coffers or fill up those holes. And once you get that kind of capex or that kind of power, then you get into capex. Look at the number of new hotels being opened and things like that. And if you see this whole domestic rally, the whole Indian story per se, I think that this is a sector that is very, very interestingly poised, And in India, unfortunately, the way the real estate scene is, etc., it's so difficult, to get something similar. Like I spoke about Indian hotels. Look at the Taj properties, whether it's Bombay, Goa, or Rajasthan, or whatever. I mean, they're irreplaceable. You don't have that location and that land parcels. So at some point in time, I think it will play out on a longer phase. Yes, they have got a push because of this revenge buying, but the way they are going to go about it, I think that this will then link into the whole theme of that larger Indian consumer play, etc. So
Sure. And what's your take on IT? That's again, there are two views. Some people feel that this is again a long-term trend, and valuations have corrected somewhat, but then it is right in the middle of some kind of cut in IT spending and budgets and anticipation of US recession and all of that, and the numbers have started to deteriorate only now. Right. So has the market again accounted for what is to come in the next 3 quarters, or there will be more pain to see?
So if you see IT also, there are two animals out there. There's a large cap and a mid cap space.
Correct.
Their behavior is very, very different.
Yeah.
So if you
Mid cap surprisingly has done better than
they've done
large
very
caps.
well. In fact, some of them have done spectacularly well.
Right.
So IT is underweight in our portfolio, but we do have some mid cap spaces. If you see the large cap IT, yes, they have not had very flattering numbers. There hasn't been big price damage per se, but they are not participating in the up move. IT is very important for the overall index because post banking, I think it's the second largest.
Correct.
So if your 3-4 of these large guys don't do much, they are going to create a heaviness. But as I told you earlier, that when cycles change, alternating sectors come up.
Sure.
So for that matter, it's not surprising. These are great companies. They'll do well at some point in time. They may be very good even buying time for contrarian buyers. But as a trend follower, we find ourselves in the mid-cap IT space.
Sure.
And there also there are a couple of them which are doing very, very well. So I feel that as a strategy, we are in some of these mid-cap IT space. The large-cap IT space, one doesn't know how much longer, how much lower they will go. Yeah, let them kind of figure it out, let their earnings come, and then we will get into it, because then the runway will be long. at the moment, one doesn't know. Yeah.
Sure. Atul, broadly, if you see the entire market, this whole, okay, before I go to that, maybe real estate, what is your sense on real estate? Because again, there a lot of demand traction has happened. You don't see that level of activity in the market. Of course, there was a spurt in real estate stocks, but then it doesn't look like a sustainable trend. Do you think we have the real estate cycle has decisively turned and it will have many more opportunities? I mean, it's time to nibble there.
At the ground, yes, Mahalakshmi, you can see the way, I mean, if you go around in the physical thing, there things have changed and things have definitely turned around. You see a lot of construction happening, RERA, etc., all having their, positive benefits and playouts that are happening. So definitely it is. But I find that real estate stocks tend to be a little more complicated because, that business is not as simple or as kosher, so to say, because at the ground reality, that this is one area where still the number one and number two cash element is highest in any industry. So I think that creates a little bit of opaqueness about the business. As I said, the stocks are doing well, they will do well, ground reality is very good. But my comfort comes a little slow because ultimately I need a clean business. We need clean managements, we need good business practices because only then do things translate into the bottom line on a genuine and on-merit basis. Very often when that number can be changed very easily, it leaves a lot to be desired. As I said, there's a lot happening. The sector is doing great, yes, but if it suits a certain investor style good, probably doesn't suit my style at the moment.
Sure. So the question I was about to ask is, you look at the market across the board, whether it is capital goods, any core sector, real estate, autos. It's only the ancillaries that are really doing well. Whether it is, you look at business-wise also, their growth rates are better. In the stock market also, the mid-cap, small-cap companies have done much better.
Right.
Is there something fundamentally changing here? Why is this happening across the board?
I think that, as I said, that last 10 years were a difficult year for the industry. And when you go through difficult years, a lot of companies and businesses shut down. And then you had COVID and, various issues, demonetization, GST, COVID. And you'll find that those who were not the fittest did not survive. So the number of people who survived are very few. There were people, with good practices, good balance sheets, great products, great capital flows, etc., etc. So you'll find that the number of companies that survive are very few. So when there is the revival, we are assuming we are talking with that, all orders flow to these handful of players. And that is why you will find that these tend to have that kind of delta that is playing out. As time passes, a lot more businesses will enter, a lot of these companies will go in for capacity expansion, and then the excesses will happen, which typically happen in every cycle. But as I still feel that in spite of them running up so much, I feel that we are in a very early stage. And this kind of run would play out for the next few quarters. And as I said, for us, this coming quarter is going to be very important because if the surprises happen, there is a feeling that, hey, these have gone up too much, they are expensive, but I think it can lead to a bit of a shift in perception and how long the runway is.
Sure. What's your take on autos, Atul? Because again, here in two-wheelers, there is a lot of momentum. At the same time, there is a shift happening because now everybody is coming to eat into iShares space. And of course, there is a lot of, overall also there is this EV disruption. And last year, you look at any stock which had an EV plan. Of course, Tata Motors already executed, showed very good execution. So that's a different story. But otherwise also, a lot of others would just move up only because they had funding plans or the visibility around the EV strategy was becoming clear. How do you see this space, one, in the near term, and are there any clear winners emerging out there? And auto versus auto ancillary, would you put your money in auto ancillary clearly?
Yeah. So in our portfolio, again, we are overweight auto ancillaries. The auto stocks are doing well. You've got to give them credit. But again, as I spoke about in the previous, the number of players, good quality players, are very limited. So we feel that there is a better outperformance that is happening in the auto ancillary space. And even that, if we try to look for a theme, because if you look at the auto ancillary space, there are 100 stocks.
Yeah.
So it's very difficult to own all of them. You'll find that the theme is electric. So whichever companies are working towards electric mobility, that is one very big theme playing across industry. Even we spoke about IT mid-cap. You'll find that those IT mid-caps which are providing to autonomous driving, etc., such new age
Right.
vehicles, there is a different color to that.
Right.
And that is also happening in the auto ancillary space. So we feel that, that if you are able to identify some of these themes and they play out, or these companies deliver rather than just promise and good fancy brochures, I think that that is really going to play out. So we are playing, we have almost a 10% plus allocation to electric mobility, so to say, which is
Okay.
a part of auto ancillaries, which is a part of the larger auto.
Sure, sure. Just one final question. They say bull markets climb a wall of worry.
Yeah.
So what's your worry?
I think for me, the big worry is going to be bond yields. It's going to be inflation, because the risk is that we do think that we are almost there as far as rate hikes are. But when I look at commodities, I don't think that commodities are going to, you may have the base effect and all the calculation, etc. But I don't think commodities are really going to be the way they behaved in the last decade, secular. I think these are going to be range bound, and you're going to have ups and downs. And also I feel that commodity is one part. Second is the whole wage side. Wage inflation, labor is a very big issue. And I think that the Western world is demographically so badly skewed that they don't have that number of people. The only alternative for them is to allow immigration. Politically, immigration is not welcome due to the events in Europe and the US. So where are they going to get that people? Where are they ultimately, if you don't let them in? And neither can you change your demographic shift overnight. So really the number of people, I think the whole labor and wage thing is something. Commodities, what happens is you dig more, the prices change, more capacities come up, and these things get sorted in a year or two. Demographic things take decades and lifetimes. The only way to replace them is through immigration, to get foreign labor, and which is really, really the biggest barrier that is there due to political and other social events. So for me, that is really that of course the longer term thing. But I always keep an eye out on inflation and commodities, because if that again starts, due to whatever reasons, we don't know, the world is so dynamic, then I think that the whole equity move can get a bit tested. Yeah.
Sure. That's all, Atul. Thank you so much.
Thanks.
Such a pleasure talking to you.
Thank you very much. Bye-bye.